Hi, this is Paul Tyler, and welcome to a special episode of That Annuity Show. Once a quarter, we have had the Chief Investment Officer of Nassau Financial Group on with us, and we've had a changing of the guards, and we have a new Chief Investment Officer, Mr. Joe Orofino. Welcome.
Thanks, Paul. It's great to be here.
I think we had you on a show. I want to say maybe a year ago, right? I think we were talking about real estate
I think that's
portfolios,
right.
maybe.
Yeah, about a year ago, maybe with David, if I recall.
Yeah,
It's been a while. It
yeah.
seems like it flies by.
Yeah, it really does. And it's interesting. We teed up some topics. Some of these are the same we've been talking about, but it's like wow, same question gets a different answer every couple of weeks here in the economy right now. So
I think that's true. There's a lot going on, right? I mean, changes every day from April to now, especially with tariffs and interest rates and where's inflation going and all those kind of things. Yeah.
yeah, well, let's maybe start talking about treasury rates and maybe talk about long term rates. See people worrying that the 5 and 10 year goes up now. For us in the annuity industry, hey, higher rates, longer term rates can
Yep.
mean higher income, et cetera. So, is this a good thing for the annuity industry if the long term rates go up, or is it bad?
Yeah. Generally, I think it's a good thing. I mean, with interest rates, the Fed's signaling a couple of cuts this year. Markets are now predicting 3 cuts by the end of the year. I'm more in the camp of 2, but let's see where things go. But look, generally for annuities, higher interest rates are good, especially for new contracts, right? Because they allow insurance companies to offer more attractive payout rates because we can earn more on the investment side, right? And that's generally a good thing. The specific impact can vary depending on the type of annuity that someone is looking at or considering. But generally speaking, when you think about the benefits of higher interest rates for new annuity purchases, so it's a couple of things, right? Higher returns for fixed annuities, for example, and that means someone could lock in a higher rate for a specific term. That could accelerate the growth of retirement savings, right? You could have increased payouts. Income annuities, for example, purchased during a higher rate environment can provide a larger stream of guaranteed lifetime income for the same premium. So that's a good thing. And then, more competitive guarantees, right? For fixed index annuities, for example, the high rate environment leads to stronger cap and participation rates, right? Which increases potential for market link growth. So there's a bunch of different factors, with higher rates, for annuities that are good. Some nuances by product type, but generally it's a good thing.
Yeah, and I think a lot of these predictions have been predicated on, how this, the great big beautiful bill works out, because it's hard to
Yeah.
say. Will the tariffs raise, taxes, and therefore the deficit comes down? Do the tax cuts stimulate the economy, or are they, or are they effectively, a drag? How long does it take? Do you think it's going to take for something like this to play out, where we could say, "Oh, that was the answer"?
Yeah, that's a good question. I think it's medium to long term, right? I mean, the impact of tariffs, in my view, has to be coupled with something on the tax side for the U.S., right? If you think about tariffs, it's more of an external revenue type of thing where taxes are internal, right? We pay taxes, we go through the IRS, it's internal. So there's got to be a balance between tariffs and higher prices for consumers, or impact to higher prices for companies and consumers, and balancing that on the other side with lower taxes. Otherwise, you'll have increased inflation. Inflation's not great for all of us. Inflation helps because it offers potentially higher interest rates. So there's a balance, but I think it's more over the medium and longer term.
Yeah. Well, speaking of inflation, Dave and I talked a lot about eggs, and other items over the last couple of quarters. I saw some projections of inflation, sort of normalizing around 3%. I mean, should this be a big discussion point for somebody counseling their client on retirement, or is 3% okay?
I think for the time being, going into the end of the year, 3%'s okay. Inflation's hovering right around 2.7% now. It'll vary over time. The Fed's target's 2%. So we're not quite there yet. Still more work to do. But look, my view and kind of where we're at as a firm is we think it'll hover going into the end of the year, somewhere between where it is now at 2.7% and 3%, right? And there's a lot of factors that play into that. It's not easy to project, right, how things will pan out. I mean, you've got tariffs, which we just talked about, on the one hand, driving some volatility, how that plays into taxes for the U.S. You've got generally rising inflation expectations, higher prices. I mean, I think we all feel it when we go to the grocery store and buy the essential goods, right? But you've got things like strong demand for housing and other factors playing into it as well. So yeah, I think it'll moderate over the longer term. But, look, probably going into the end of the year, we'll kind of hover where we are now, maybe trend a little towards towards 3%. And then, look, we got the midterms coming up next year to think about as well. So that could drive change as well, depending on the outcome of that. So I do think there's a lot of factors going into the next kind of 6-12 months that'll play into it.
Yeah. When I first got into this business, I remember reading, projections, for the Social Security Trust Fund is going to run in 2035. So that sounded like a long time in the future. And now it's not that far off. And I even heard that 2035 is turned into 2033 by some calculations. Now, I don't know if this is weird news. I never would have imagined hearing us create a U.S. sovereign wealth fund and then using proceeds to fund the Social Security.
Yeah.
What are your thoughts? You're an investment guy. I mean, can the government pull this off? Is this something we should count on?
Yeah, I don't know if we should count on it. And I agree with you. Somehow we continue to get older and don't necessarily think about it, but a couple of days closer to retirement age, right?
Right.
So
every day.
Every day. So look, sovereign wealth fund's not a bad thing. Using it to support Social Security, I don't know if that's the right answer. In a way, you're kind of just shifting the issue from left hand to right hand, right? So is it an idea? Yeah, it's an idea. Could it potentially help? Maybe over the really long term, because you're not going to build a sovereign wealth fund in 6 months or a year. It's going to take time to do that. So I don't know. Is there other ways to do it? Could you fund Social Security differently? Maybe you could. But having said that, look, I do think annuities can be a good offset or a good complement to the potential issue with Social Security over the long term.
Yeah, I think the discussion, I think the fact that the government's potentially taking very different options to fund this, I think should be good impetus for people to take their retirement planning in their own hands. And
agreed,
annuities are great solutions. For doing that.
They're one tool in the toolkit, right?
Yeah, exactly. Now, you talked a little bit about interest cuts. Maybe we can double click a little bit into that. I think people think that the Fed is setting short-term interest rates, and then you're the expert on it. Maybe you sort of talk us through. Okay, they cut that. What does that really mean, and how does that translate into some of these rates that are meaningful for the annuity community?
Yeah. No, that's a great question, and I don't know if I'm an expert in interest rates. If I was, probably wouldn't be sitting here. But yeah, it's a good question. I mean, look, the Fed itself is signaling 2 cuts by the end of the year. The market's predicting 3, and it's really driven off of the backdrop, the economic backdrop, and the news that we're seeing, coming out this week, right, with unemployment and where the economy is going. So still somewhat a lot of uncertainty driving things, but the Fed's kind of targeting 2 cuts by the end of the year. And look, I'm in that camp as well. I don't think we'll have 3. There's not much time left unless they're super aggressive, right? Which I don't think they will be, and they haven't signaled that either. So what does it mean for interest rates, and for annuities? If you think about the rate cuts, it's really factored into the short end of the curve. So maybe a little bit of an impact on the 5-year rate. Maybe the 5-year rate comes down a bit, not a lot, because the curve will steepen. It has steepened, and it'll probably continue to steepen a bit. And I think the 10-year will kind of hover around where it is, right? Especially if inflation hangs right around kind of 2.7 or 3%. There's really no reason for the 10-year to kind of come down or even go down a lot, right? Likely it'll stay where it is and maybe even go up a bit. So good, okay outcome for annuities. I don't think it's a negative impact for annuities. I think it's really kind of hanging in there over the course of the next year and using using the view on rates as a tool to think about annuities within the retirement portfolio.
Yeah. Well, I think a lot of agents, tend to be conservative in allocations inside, fixed index annuities. Put all the allocations to well-known indices like S&P 500, NASDAQ, 100. Very interesting time. We've talked a lot about AI power, driving the economy, driving growth. Now you start to look at the S&P 500. Yeah, it's not the S&P 500 it was, 10 years ago. It's now you look at those stocks. You put money in the S&P 500. It feels like you're putting it in AI or technology firms. Are there risks that people should start thinking about, and should people think about different allocation strategies in some of these annuities?
Yeah, well, look, I'm a big believer in portfolio diversification. If you think about us as an insurance company, Nassau, our portfolio it's pretty diversified in terms of holdings and kind of position sizes. So big believer in diversification, from an institutional perspective and from an individual perspective. Look, I do think AI will persist, but it'll probably persist over the longer term. And Look, as Bill Gates once said, over the next 3 years or so, tech will underdeliver what you think, and over the next 10 years, it will overdeliver what you think. So certainly will play in over the longer term. I don't think there's an immediate need to shift allocations or strategies, but I do think if someone's building a retirement portfolio or even has a retirement portfolio, they should build in diversification and include things like annuities, equities, of course, annuities and fixed income, just to build diversification, because you want to support your retirement goals. You want to diversify risk. You don't want to concentrate your portfolio in one sector, to your point, that has a lot of things going on. And if you think about AI and its impact on the economy now, and you think about unemployment, where it's really hitting unemployment is in the tech sector. And I actually saw an interesting stat today, is that it's really hitting males more than women, because a lot of males are going to school for computer science, and those are the jobs that are being impacted by AI. Right? There's less demand for computer science jobs for kids coming out of college with those degrees. So it's an interesting dynamic and an interesting time to think about it, but I do think we're still kind of early into the development of it.
Yeah, no, well, I totally agree. Listen, thanks for your time. And I guess, we tend to turn the news on. The news gets us to turn on, but with bad news. I don't know. What parts of the economy are you most positive on? Where do you see where's the daylight here?
Yeah, it's a good question. I mean, from a sector perspective, financials and banks, insurance companies, obviously, we work in an insurance company. So that's always a bright spot. And inflation always kind of worries me, but I do think we'll kind of hover where we are, and the Fed will continue to focus on inflation and get that in check. So maybe cost of goods will kind of level out, and over time, that'll help all of us as we're thinking about retirement, going to retirement. Prices will always go up, but they should moderate over time.
Yeah. Hey, well, listen, Joe, thanks. Really appreciate your insight and your time. And for our listeners, hey, be sure to pass this on to anyone who you think would benefit it. And join us again next week for another great episode of That Annuity Show. Thanks.
All right. Thanks, Paul.
Thanks.
Thanks.